Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. Coming to you from sunny Key West this week because money never sleeps and it doesn't take a holiday, except for the 10 days of the year when the market does take a holiday. But anyway, I've got you covered. And Nation, everyone is watching the market for this week's tariff announcements and the monthly jobs report on Friday. While I pointed out these two events in last week's video and why the market retouched its correction sell-off last week, we could be setting up for a major rug pull heading into earnings starting April 11th. I'll explain why the market could rally this week only to retouch those new lows very quickly, along with the 5 stocks I'm buying anyway and the stocks I'm watching this week. But first, if you've ever wondered what's in my portfolio or wanted to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. The app was created by investors and for investors. I just started using it last year and love the app for getting ideas and sharing my own portfolio. This isn't just another investing app though. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 250,000 investors in the social feed to see what everyone else is talking about. I've shared my portfolio on the app and it's totally free to download, so look for that special invite link I'll leave in the description and check that out. Back to our main topic though, and I highlighted last week why I do not think this market is done falling. You can call me a negative Nancy if you like, but this coming month could be volatile like we haven't seen in years, and I outlined 3 key reasons along with the 3 dates I'm watching. We see the first of those dates this week with the April 2nd deadline for reciprocal tariffs, and whether the president delays or negotiates some lower, the fact is tariffs will go up over the month. That's going to lead into business uncertainty and higher prices, both for businesses and consumers. Now this week, we're also going to see the start of another of those 3 factors I'm watching, the effect of federal spending cuts on the economy. Friday's jobs reports is going to be the first to include some of those DOGE cuts, and while the market has largely shrugged these off so far, federal spending is nearly $1 in $4 of economic activity, and the real size of the government at over 10 million jobs means that 10 to 20% cut the administration is targeting is going to hit the economy. Now the third date I highlighted doesn't come until April 11th with the start of the first quarter earnings season, but that's going to be the big one. It's here that we're going to see companies against all that uncertainty in the policy and the economy look to cut their sales and earnings outlook for the year just in case. Now against all this pessimism, I did highlight last Wednesday why I'm still buying the dip in some of my favorite growth stocks anyway. Even as the market falls further into correction territory, there are none of the catalysts for that full-blown stock market crash. With the average of 26 corrections since World War II, seeing the market down 13.7% on average, lasting just 4 months from the low to the new peak, you don't want to wait for that market bottom to start buying these rebound stocks. For this week though, I wanted to highlight stocks that I'm buying no matter what the market does, some of my favorite forever stocks to just keep on buying. A forever stock is really a company not only in that fast-growing industry, a growth theme that's going to develop over 5+ years, but one that is growing sales faster than others in its industry. Now that faster sales growth means it's taking market share from competitors, and one of your best clues into a competitive advantage that is going to take that stock higher. And for these stocks, I like to first look to those biggest growth themes out there, like the evolution in AI and automation, along with cybersecurity demand. More than anything else, these 3 themes are going to change our lives over the next decade, and the winners in each are going to 10x your money or more. Within each growth theme, I built a list of those pure play companies in the market along with their annual revenue and their revenue growth. This helps me find those growing faster and taking that market share in their trillion-dollar addressable markets. Let's get started with the best stock positioned in that data center build-out theme, Broadcom Inc., ticker AVGO. That rush to build out data centers is the dominant bottleneck in AI right now, with Amazon CEO Andy Jassy highlighting it in the last earnings report. We could be growing faster were it not for those constraints on capacity, with those constraints being the race to build out those data centers to do more with artificial intelligence. And Amazon isn't alone. Hyperscalers like Amazon, Meta, and Google are expected to spend over $1 trillion over the next 2 years on those data centers, the hardware and the software, and Broadcom is going to be right in the middle of it. And while I also like Arista Networks, ticker ANET, and Astera Labs, ticker ALAB in that networking theme, one of the biggest constraints within the data center boom itself, Broadcom is going to benefit from the entire stack of hardware and software in that build-out. Not only does Broadcom dominate in that networking theme with its Ethernet switches and network processors, the company supplies data storage solutions with its RAID and tri-mode controllers, its ASICs and custom silicon support hyperscales AI workloads, and a hardware-based security is available through its TPM chips. And while revenue growth is expected to slow to 16% next year, I think the company keeps it closer to that 20% pace forecasted this year on that dominance in the data center infrastructure. And while the stock isn't cheap at about 15 times on that price to sales valuation, the 20% growth is going to continue for years, and take this one along with it. You out there in the nation know cybersecurity is my favorite long-term theme, and my favorite within that is CrowdStrike Holdings, ticker CRWD. While leadership changes every once in a while within the cybersecurity space, CrowdStrike's Falcon platform is the best option right now for enterprise security. Its AI-native security is driving a 27% annual rate in annual recurring revenue, that subscription revenue that is extremely sticky and is just going to keep on growing. Even the largest tech outage in history last year couldn't keep the shares from reaching a new high within 7 months. But then that giant opportunity in cybersecurity means I'm not investing in just one stock here. With a 20-fold increase in malicious programs just in the last decade and 10 million people affected in 2022 alone, cybersecurity is already a $116 billion addressable market. And now with AI transforming that threat landscape, making attacks even easier, the market is expected to grow to $250 billion by 2029, a 21% annualized growth. So here, I also like Palo Alto Networks, ticker PANW, for its overall growth, profitability, and that size advantage. In research I put together on the cybersecurity stocks, Palo Alto doesn't blow the doors off with just 15% annual revenue growth compared to 25% at CrowdStrike, but it does have the second highest profitability in the group, an operating margin of 11%, when 5 of the other 7 stocks post negative profitability on a GAAP basis. Palo Alto leads in its platformization approach, using its scope to consolidate security solutions into a unified product, an all-in-one player. The company is also trying to lean into the emerging threat and opportunities from AI with an AI-powered firewalls to real-time cloud security through its Cortex Cloud, driving a 100% detection score in the latest MITRE test. And as much as I hate it when YouTubers use a stock chart as justification to buy a stock, like buying stocks that have only gone up is the only analysis you need to do, you can't deny Palo Alto's history of returns here. 20 times your money over the last 13 years for a surprisingly consistent 26% annualized return. Now I am breaking one of my rules here and buying shares of Advanced Micro Devices, ticker AMD. It's obviously not the dominant player in the industry, but has a 56-year history of growth in tech, and this is one just too cheap to ignore. On growth that most CEOs would sell their firstborn for, 23% this year to $32 billion, shares of AMD trade for just 7.2 times trailing sales, and even lower, just 5.7 times this year's revenue. That's a 48% discount to the average valuation over the last year. And industry news here points to the possibility that growth is underestimated. NVIDIA and its Blackwell upgrade have faced multiple delays, and it now appears there's going to be more delays in its 5000 series GPUs that AMD might be able to take advantage of to take market share. Retailer checks are reporting that AMD is pushing 2 to 4 times more GPU inventory availability, and while NVIDIA chips still have that performance advantage, it really doesn't matter if there's none available. Now, that still won't make AMD the market leader against NVIDIA's 90% share of that high compute market for chips, but if AMD can even show that it's chipping away at that share leadership when it reports on April 28th, this stock is going to boom higher. And now the wild card of the group, one nobody is watching but could have the biggest potential, Symbotic Inc., ticker SYM. The company is using AI-powered robotics and software to automate warehouse and logistics with a tie-in to the world's largest retailer. Symbotic recently bought Walmart's robotics business, taking over development for the retailer's warehouse and delivery robots. It already has a 4-year development partnership with Walmart that has helped drive sales at a 91% annual rate of growth over the last 3 years. Forecasts are for the company to grow sales by another 24% this year and 32% next to $3 billion, with a $20 billion plus backlog of orders. Now that growth is going to continue for years. Besides Walmart, Symbotic is also working with Target and Albertsons, defining its leadership in the $432 billion market for robotics warehouse systems, along with another $500 billion market on the operational side. At just $13 billion market cap, this company is still tiny compared to some of those other tech leaders on the list, making it possible to see multiples on your money as it grows into that market opportunity. Now, instead of highlighting those stocks to watch and the sector level investing this week, I want to highlight what could be the biggest head fake of the year for investors. This week begins the 3 dates and key events to watch for to know how far stocks are going to fall and when to get more aggressive at buying that dip. Now, I'm still using the barbell strategy we've been talking about lately, keeping half of my portfolio invested in those high growth stocks and the other half in cash-like bonds and money markets to buy in at those lower prices. That strategy could become even more important this week if we get some kind of a rally than a massive rug pull that I'm going to warn about next. We are going to see some important data this week, first in the trade deficit, which is reported on Thursday. Now, this difference between the value of the goods imported minus those exported is usually kind of a non-event for the market, but this month falls on a day after President Trump unveils his plans for across-the-globe tariffs. That trade deficit then, expected to show Americans imported $123 billion more than it exported, is likely to be used as a talking point by the administration as a need for those tariffs. And it's those tariff events was the first event and the date that I talked about in our 2025 market playbook last week. Friday's monthly jobs report is the second one here and could start showing the effects of those government layoffs and a slowing economy. Economists expect the U.S. to have created just 140,000 jobs in March, lower than the 151,000 created in February, and well under last year's $170,000 pace per month. Stocks in the S&P 500 closed Friday back to that correction level we reached March 13th, down 10% from the January peak. Last week's renewed sell-off was kind of a sell the rumor trait of the market as investors try to get in front of expected news. This is often followed then by that buy the news, where investors buy back into stocks when the news isn't quite as bad as feared. That might be what we get this week and a rally in the stocks if the Trump administration delays or just waters down some of those tariff announcements. The danger here, though, is it turns into a major head fake and just catches investors fully invested when the market crashes again in the coming weeks. That's because the third major data highlighted last week was April 11th, the start of the first quarter earnings report and what is likely to be the start of a bigger sell-off in stocks. That's because tariffs, inflation uncertainty, and just a generally weakening economy have already driven a sharp drop in the estimates of what companies are going to report in their earnings for that first 3 months of the year. In a chart by FactSet Earnings Insight, we see the sector-level earnings expectations for companies in the S&P 500 compared to where they stood at the beginning of the quarter. In January, analysts expected the 500 companies in the market index to report profits that were 11.7% higher from last year. But then given company commentary during the first quarter earnings report, plus the bigger picture uncertainty in tariffs, inflation, and the economy, those earnings are now expected to be just 7.3% higher than last year. Some of the sectors have seen even greater downgrades. Companies in the consumer discretionary sector expected to post solid earnings growth of 11.5% when the quarter began are now expected to show just 1.6% profit growth. Companies in the materials sector expected to post 7.1% growth just 3 months ago are now expected to report a drop of 9.8% in profits. But here, more important than those first quarter earnings reported is going to be what companies say about the second quarter and the full year outlooks. Right now, the market expects companies in the S&P 500 to report earnings growth of 9.4% for that April through June quarter and 11.4% for the full year. Now, both of these are extremely high bars to meet given the slowing economy, and companies are likely going to want to manage those expectations lower to give themselves a better chance of beating when profits are reported. Within all this, the reason a renewed sell-off is coming during those earnings reports is simpler, but I have to go all numbers nerd on you. In statistics, anytime you try estimating a number for the future, you create a range around what's likely. Now, a company might say it believes full-year earnings are going to come in between $1 and $1.50 with a midpoint of $1.25 per share. Now, on these and their own research, analysts set their company and broader market valuations. If a company is expected to post that $1.25 per share earnings, the stock generally trades for around 10 times on a price-to-earnings valuation. An analyst might put a $12.50 target on the shares. But then here, a defining concept in statistics is that with more uncertainty in the input, you have to widen your forecast range. That supernormal uncertainty in the form of tariffs, inflation, and the broader economy is what companies are dealing with right now and what is about to crush stocks once again. As companies come out with Q1 earnings and then give updates to their Q2 and full year forecasts, they're going to have to widen those range of earnings estimates to account for that uncertainty, and the ranges are going to be to the downside. That company may still think it can hit that $1.50 full-year earnings if possible, but if the economy weakens and inflation returns, it might also only hit 50 cents in earnings, so that's going to be the new range for the year. Now, instead of a $1.25 per share midpoint between those two ranges, we have a $1 midpoint. That feeds into that price target. That 10x valuation becomes a $10 target. And all of a sudden, the stock target is 20% lower. And we're going to see when that happens across the entire market, you get a drastic revaluation of the market, and there's nothing investors or Wall Street can do about it. Economic and policy uncertainty is increasingly high, and just simple math rules are going to force a change in those estimates. Analysts are going to have to adjust their company-level price targets, and it's going to flow into those market-level targets as well. Now, the good news in all of this, as I've been talking about over the last 2 months, and there is a bright side because household finances are still healthy, and there's plenty of room for interest rate cuts to support the economy. We shouldn't see this sell-off become a bear market crash. Now that should keep the overall price drop to less than 20% from that S&P 500 peak of 61.47 we saw earlier in the year. As stocks do fall again during earnings season, it's going to set that stage for the buy the dip that is going to make millionaires. Join me on the Blossom Investing app free with the special invite code in the description below and see what 250,000 investors are talking about. Or click on the video to the right to see those buy the dip stocks I highlighted last week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.